Welcome to The Explainer. Today, we're putting a true aerospace and defense heavyweight through a seriously rigorous test. We're running General Dynamics through what I like to call the valuation gauntlet. As an investment analyst, it's just not enough to glance at a stock chart and call it a day. We need to evaluate the raw financial data through the battle-tested frameworks of legendary investors. We're talking Warren Buffett, Peter Lynch, and Benjamin Graham, before we cap the whole thing off with modern discounted cash flow models.
Okay, let's dive into this. Here's our roadmap. We'll start with a quick company snapshot, then sequentially apply the Warren Buffett, Peter Lynch, and Benjamin Graham lenses. After that, we'll run our DCF and alternative models, and finally, wrap it all up with our synthesis and final verdict.
All right, Section 1, Company Snapshot. Let's look at the raw Q1 2026 data right from the source.
So, our anchor for this entire analysis is the current stock price, $374.60 per share. That price tag gives General Dynamics a market capitalization of right around $102 billion. Keep this number in the back of your mind as we run our intrinsic value tests, okay?
Now, what's really interesting about this slide is the sheer scale of their profitability. In Q1 2026, General Dynamics reported $1.42 billion in operating earnings. Think about that. Not only is that up 12% year over year, but their company-wide operating margin actually expanded by 10 basis points to 10.5%.
And the top and bottom line growth? It's incredibly healthy. Revenue hit $13.48 billion, which is a 10.3% increase. And earnings per share reached $4.10, up 12%. But as an analyst, my eyes go straight to the cash. They generated a massive $1.95 billion in free cash flow this quarter alone. That is a staggering 174% cash conversion rate of their net income. As their CFO noted, it's just an outstanding cash performance driven by working capital reductions.
Plus, that revenue growth isn't just coming from one lucky break. It's broad-based across all four segments. The aerospace division hit an all-time Q1 record with 38 Gulfstream deliveries. Marine Systems saw a massive 21% revenue surge, largely driven by nuclear submarine production like the Columbia-class. Combat Systems grew nearly 5% thanks to high international demand for munitions and vehicles. And the technology segment, it expanded by 4.2%, fueled by strength in their mission systems.
Moving on to Section 2, the Warren Buffett lens. Let's see how the Oracle of Omaha would view this.
On the qualitative side, Buffett would be absolutely enamored with General Dynamics' economic moat. They basically share a duopoly, and in some cases, an outright monopoly on incredibly complex assets like U.S. Navy nuclear submarines. You just don't see startups popping up to compete with that. That moat translates into a massive $130.8 billion funded and unfunded backlog. Furthermore, management has proven their capital discipline by increasing the dividend for 29 straight years. Talk about consistency.
Now for the math. Buffett's favorite quantitative metric is owner earnings, basically the true unencumbered cash a business generates. For Q1, if we take their $1.125 billion net income, add back $232 million depreciation, and subtract $203 million in capital expenditures, we are left with a robust $1.154 billion in quarterly owner earnings. With manageable debt and a deep moat, Buffett would love this business. But is there a margin of safety at the current price? We'll hold that thought for our final synthesis.
Let's shift gears to Section 3, the Peter Lynch lens, where we balance growth and value.
Lynch famously categorized companies into different buckets, and General Dynamics, it fits the definition of a stalwart perfectly. It's a massive, established entity offering great downside protection in economic downturns, yet it's still growing steadily. Remember, their EPS grew exactly 12% this quarter, which lands right in the sweet spot for a classic Lynch stalwart. But here's the defining metric for Lynch, the PEG ratio, or price to earnings divided by the growth rate. Management just raised their 2026 EPS guidance to a midpoint of $16.50. At our $374.60 stock price, that gives us a forward PE of 22.7. Divide that 22.7 PE by their 12% growth rate, and we get a PEG ratio of 1.89. Now remember, for Lynch, a PEG of 1.0 is fairly valued. So a 1.89 PEG, that signals this stock is definitely pricey relative to its near-term growth. Lynch also heavily scrutinized balance sheet strength to assess risk, and General Dynamics shines here. Based on the data, they boast a very healthy debt-to-equity ratio of just 0.38. That is fantastic downside protection.
Now, while Lynch usually preferred underfollowed stocks with low institutional ownership, which, let's be honest, a $102 billion defense contractor certainly is not, the rock-solid balance sheet keeps this firmly in his stalwart hold category.
All right, Section 4, the Benjamin Graham lens. Time for the strictest test in our gauntlet.
So the crucial point is that Graham used a very strict defensive investor checklist. Let's walk through it. General Dynamics easily passes the size test with its $102 billion market cap. They pass the financial strength test with strong liquidity and just $4.36 billion in net debt. They pass earnings stability and the dividend record test with flying colors. But there is a final hurdle: moderate valuation multiples. And at a 22.7 PE, they completely fail Graham's strict valuation ceiling.
Let's actually calculate Graham's intrinsic value to see the gap. Using their $8.01 billion in total debt and that 0.38 debt-to-equity ratio, we can deduce a book value of roughly $78 per share. If we plug this, along with that $16.50 EPS, into Graham's famous intrinsic value formula, we get $170.16. That is less than half the current stock price. For a strict Graham value investor requiring a deep margin of safety, this is simply far too expensive to touch.
Let's move to Section 5, DCF and alternative models. Can future cash flows justify the current premium?
We'll build a base case discounted cash flow, or DCF model, leveraging that massive $1.95 billion Q1 free cash flow as our jumping off point. We project out 5 years, assuming a conservative 8% weighted average cost of capital and a modest 2% terminal growth rate into perpetuity. The DCF model suggests the stock is currently hovering right around its fair value.
And this brilliantly illustrates the delicate nature of modern valuations. If we run a sensitivity analysis, tweaking the discount rate down to 7% or the terminal growth up to 2.5%, the fair value swings significantly, easily absorbing the current $374 price tag. Conversely, if defense spending slows and the discount rate rises to 9%, the fair value drops fast. Essentially, the DCF says the stock is, well, it's priced per perfection.
We can also cross-check this with a dividend discount model, or DDM. They pay a $1.59 quarterly dividend, which is $6.36 annualized. If we assume a 6% long-term dividend growth rate and an 8% discount rate, the DDM points to a fair value of around $337 per share. Again, slightly below the current trading price, but definitely in the same ballpark.
Finally, Section 6, Synthesis and Final Verdict. Let's bring it all together and see how this builds. Here is our definitive master summary. We have a phenomenal underlying business, no doubt about it. But at $374.60, the Buffett lens suggests a hold, because while it's a wonderful business, the margin of safety just isn't wide enough for a new purchase. The Lynch lens says hold because at 1.89 PEG is a bit pricey for a stalwart. The strict Graham lens screams sell based on pure asset value. And our modern DCF and DDM models suggest the stock is, at best, fairly valued right now.
To balance this verdict, we have to weigh the absolute safety of their pipeline against present execution risks. General Dynamics boasts an astounding $188.4 billion total estimated contract value. That is effectively guaranteed future revenue in an uncertain world. However, as noted in their earnings transcripts, they face real ongoing risks: supply chain cadence issues, single-source supplier vulnerabilities, and elongated government procurement cycles.
So what does this all mean? The data makes one thing absolutely clear. General Dynamics is a wildly successful cash machine with an impenetrable moat. But the market knows this and has priced the stock at a premium. So the ultimate question for your portfolio is this: in a highly unpredictable global landscape, is the ironclad security of General Dynamics' moat worth paying a premium for today? Or do you wait on the sidelines for a true margin of safety? Think about it. Thanks for joining me on this explainer, and keep testing those valuations.